Welcome to the weekending money flow review at Wealthy Bucket. This complimentary video highlights the results and analysis forecasted from the previous week's Bucket Weekly newsletter. Our Bucket Weekly newsletter is available each and every Sunday to premium members that prepare our readers for the upcoming trading week. Wealthy Bucket does not provide investment advice. Please consult a financial professional before engaging the markets on your own to see if it is right for you. Trading and investing in stocks, options, currency, and futures can result in a financial loss. So let's take a look at the markets from a weekending perspective. And we talked about how we expected the yen to break out last Sunday we wrote about it last Sunday and said the yen can't hang in the pocket, so to speak, for too long. You can see the tight consolidation for almost 2 weeks of trading, and we talked about how it's going to break out, and it broke out this week. It's starting on Wednesday, the yen really broke out. Now, here's the problem. Historically, the yen has, when it moves higher, equity markets move lower, and vice versa. It's a very reliable market indicator for investor sentiment in the markets. The problem now is that the S&P hasn't moved downwards as much as the yen has moved up. The market actually traded up while the yen traded up, and all the correlations right now are breaking. Okay, they're breaking for the first time in a number of years. The correlation in the markets, meaning when yen goes up, equity should go down, dollar should go down, and equities should go down as well. Problem is dollar is moving downward, equities are moving higher, and yen is moving higher, and equities moving higher. So that means the correlation, the model itself, it's not broken per se. What it is that there's very high risk in the market right now because there is a lack of correlating factors as to why the market is moving the way it is. And when you have very little correlating factors, your risk is high because you can't logic with it so much. And I know that the market is not a logical beast, so to speak. There's very little rhyme and reason as to why the markets are reacting and behaving the way it is, and if that's the case, which it looks like it is, your risk is at the highest, which means picking the direction of the market will be difficult until the correlations return back to normal. And we don't know when that's going to be. We just have to prepare for that, and that's the message that we're going to be conveying to our members in this weekend's premium Bucket Weekly newsletter and forecast, that the risk is at its highest and how to prepare and protect yourselves from that risk. And so that is a quick review of the market. If you are not a premium member, that's okay. We're going to give you some value regardless, but you can see how nothing is exactly making sense right now, and that's the gist of it. If the market's not making sense, you can't back engineer it, you don't know why it's happening, then your risk is at its highest, and the best thing to do is just not enter into new positions until the market returns back to normal behavior. Normal behavior does not mean up, it does not mean down, it does not mean sideways. Normal behavior simply means that there are proper correlations within the market. There's rhyme and reason as to why the market is moving up, down, or sideways. And right now, we just don't have that, okay? And if that's the case, again, I'm going to say this again and again, that your risk is at its highest point. So let's take a look at the Dow. And the Dow traded back into immediate support, which is fine. However, we did get stopped out on one of our trades this week, and that is moving lower. We talked about how it would be best if the traders out there are prepared for some short opportunities going into this week, just to prepare themselves or to protect themselves in the event that the market does roll over, because we were expecting the yen to break out, and that was either going to break downward or break to the upside. We're not here to make a call whether it's going to go up or it's going to go down. We just have to wait for it to do it, and then we can make our call. And as I mentioned earlier on, that because there's very little correlation right now, then your risk is at its highest point. And to prepare for some short ideas, the Russell did perform better than most of the markets out there this week. In terms of the North American markets, the NASDAQ performed very, very well. As you can see here, it is probably the best performer and for the North American equities or stock markets this past week. So the takeaway right now is if you are in positions, you probably want to tighten them up. You don't want to add to your positions right now simply because you just don't, there's no correlating factors to why the market is still moving upwards. It's grinding, so to speak, right now. You can see the S&P 500, it's moving very, very slowly. And that means there's not a lot of bidding going in or a lot of offers. The large market participants, the large institutions, and the large investors are taking a moment to figure out what they want to do next and how to position themselves. So the best thing to do is don't add to your positions. Wait for the market to make a move. Probably tighten up your stops is not a bad thing to do right now. And if you're not in the market, you don't have any positions, you're sitting in cash, it's probably good. It's suggested that you just remain in cash right now until the market normalizes, so to speak. And by normalize, I mean it picks a solid direction, either up or down. If you have any questions, email us at service@wealthybucket.com. And we hope you have a great weekend.